Hey everyone, welcome to the sweep. We're going to get started here in just a second. All right, let's go ahead and get going. Like, share, and follow on social media. There are social media links. Let's go ahead and jump into things. We're going to look at Forex news like we usually do at first. So let's look August 28th to September 3rd. 2021. So let me go ahead and pull that up really quickly. All right. So the 28th, day 3, Jackson Hole Symposium. So remember, this started on Thursday. So if we go back here, we can see day 1 of Jackson Hole Symposium is right there. If you're not sure what that is, click on it and you'll see Federal Reserve Bank of Kansas City. They meet annually, Economic Policy Symposium held in Jackson Hole, Wyoming, attended by central bankers, finance ministers, academics, and financial market participants from around the world. The meetings are closed to the press, but officials usually talk with reporters throughout the day. That's why sometimes you can start seeing spikes, in the middle of the day and there aren't any other announcements because they've kind of come to a recess or what have you, or they'll go and they'll speak to reporters. But the symposium itself is not open to anyone, including reporters, to go and attend. So it's a closed session, and then they'll come out and make comments usually. So that was day 1. Day 2 was today. Jackson Hole Symposium, you see they're both red, high impact. And then day 3 is medium impact, and that's over the weekend. Again, we talked to you guys about this last week. We said if you had trades that were open, you want to get those trades closed before the weekend comes, because you don't want to be in a situation where you're holding over the weekend and perhaps something, something pressing is discussed or mentioned in those symposiums that cause for the market to react, and you're stuck. There's nothing you can do about it. You can't get out of your trade. You can't set a new stop loss or anything. So it's better just to be out of your trades when stuff like that is occurring over the weekend. When the market is closed to you doesn't mean it's not moving. Okay, so that brings us to Sunday. We only have some low impact for the JPY and Aussie. Monday, very low impact. GBP has a bank holiday, so be aware of that. That can affect volatility only because that could decrease volatility because the Great Britain pound banks are not going to be open. A few medium impact. Pending home sales for U.S. dollar, manufacturing PMI for the CNY. Let's go to Tuesday. A lot of low, medium impact for the CAD, GDP month end. Chicago PMI for the U.S. dollar. CB consumer confidence. Again, we've seen these a lot this week, and so we're going to be seeing them again next week. And here's a high impact for the Australian dollar. This is GDP quarterly, and that's at 7:30 p.m. Mountain, so 9:30 p.m. Eastern. And that'll wrap up Tuesday. Wednesday, we've got some high impacts, a lot of low German final manufacturing PMI, medium impact for the euro. And then right here, OPEC meetings. So that's all day, OPEC, JMMC meetings. So these are all day. So be aware of those, because those can affect markets, throughout the day, not just the U.S. dollar, but other markets as well. And then ADP, non-farm employment change. Excuse me, that's for the U.S. dollar, 6:15 a.m. Mountain, 8:15 a.m. Eastern. ISM manufacturing PMI, that's 8 a.m. Mountain, 10 a.m. Eastern. And then a few medium impacts, crude oil, FOMC member Bostic speaks. So keep an eye out for those, but these high impact, those are the ones you're going to want to keep an eye out for. That's Wednesday, so that brings us to Thursday. Thursday, we have no high impact. We have a medium impact for the euro, Spanish unemployment change, unemployment claims for the U.S. dollar, which is medium impact, which is interesting because generally that would be high impact, especially because of what FOMC had talked about this week. If you guys want to know about that, go back and look at the news on Federal Open Market Committee and kind of the things that they had talked about earlier this week. FOMC Bostic speaks at 11 a.m. Mountain, and that's medium impact, and then retail sales month end. That's for the Aussie. Let's go to Friday. So Friday, some high impacts, right? So about a lot of low impact, and then right here, the U.S. dollar has average hourly earnings month end, non-farm employment change, and unemployment rate. Right there, look at that one, it's red. Unemployment rate, red, non-farm employment change, red, and average hourly earnings, red. Again, why? Because the FOMC is going to be keeping an eye out on these things to determine if towards the end of the year they're going to increase interest rates. And then ISM service PMI, and that's going to be at 8 a.m. Mountain, 10 a.m. Eastern. The rest of these high impact are 6:30 a.m. Mountain or 8:30 a.m. Eastern. And then that brings us into Saturday. Saturday there is nothing, so we'll pick up on that next week. And those are things you want to keep an eye out for, right? You don't want to trade on those things. You just want to make sure that you know that they're there, so you know what to avoid, right? You don't want to be involved in any of that because it's a gamble. It's anyone's guess. And again, the worst thing you can do is get into a trade like that and it work out really well for you. It working out really well for you could be possibly the worst thing that could potentially happen to you, because then you think you've got something figured out and it'll eat your lunch and you'll regret it. All right, so let's move on. So today we're going to cover, I've been working on some backtesting, and so where we talked about the golden ratio analysis last week, and by the way, thank you guys for those that have submitted backtest data, for those of you guys that sent in emails just commenting on that. You know, we did you guys a solid by releasing that information. You know, it was something that we had kind of gone back and forth about, but ultimately decided that it was, you know, it was the right time to go ahead and roll that information out so that you guys would have that, so that you could start, you know, utilizing that golden ratio analysis when you're back testing. And I want to follow up with some of that really quickly, because I want to show you guys something. Our members have access to backtest data. And this is a great way. We always say it's a great way to get you started. And that's only because we want for you to do the backtesting yourself, because there's all this byproduct education that you get as a result of backtesting. But we have a whole bunch of backtest data. Let's look at dirty pressure. That's one we look at most often. So right here we've got the euro versus US dollar. This is one setup, dirty pressure. You guys should be familiar with that setup by now. And it's got 24-hour period for buy and 24-hour period for sell, and the most optimal parameters. So like this one's like 81%, right? And then it's got a 2-to-1, which is a really good trade, right? A 2-to-1 trade. So if that's entered at 10 p.m. Mountain Standard Time or 1 a.m. Eastern, when the dirty pressure is present at 9:59, then your take profit would be 9, your stop loss 18. So that's a 2-to-1 with 81%. So just to give you guys some context there, last time we talked about, you know, being dedicated to your execution, and we kind of looked at trades and how those trades would have fallen out, and how we had a lot of, excuse me, it's been a long week, a lot of back-to-back losers. But in the end, we were able to build a 7-figure account, right? We were able to build it up to a point where we were taking out $250,000 every 2 months out of that account, and it was the same trade two times a day, and that was it, right? And we were able to just dominate with just that. And so that was a 75% win rate with a 2-to-1 risk to reward. So this is a full 6% more than that. And so when you think about 6%, it's not that you're getting just 6% more on top of your earnings. You're actually, with a 6% additional win rate, it's exponential, right? So, you know, where in that one setup it took us 2 months to get to, you know, from $500,000 to $750,000, where we would liquidate it back down to $500,000. Right here with an 81%, you could likely do that in a month, right? I mean, it would cut it down by a month, just to 81% with a 2-to-1 risk to reward if you're taking that twice a day. So there's quite a bit that can be garnered by something like that. And you can see this is just one trade, obviously, so there, the parameters will vary. Like, for example, the very next hour, the best parameters above 70%. So we don't have anything in here that is below 70%. If it is below 70%, we just say no viable trades. So you can see these do have trades that are profitable within those times, but they are below 70%. They could be 69%, and we just won't include them. So we got one here that's 95%, 71%. There's a ton of them, but that's 24-hour periods. There's 48 different, with the exception of the ones that aren't present, right? That we don't have that say no viable trades. We've got all these other ones that you can just pop in and take, and there's a way to do that. You don't want to just take them all, because obviously you need to have enough of those trades go through in order for you, that win percentage to start showing out the way it normally does. So there is a process in executing that way, but once you figure that out, it's really simple to just have this information. It's a great place to get started. And this is for one currency pair. We have it for 5 other currency pairs as well, the same way. Buys for a 24-hour period and sells for a 24-hour period, the most profitable, back-tested. And you can see a lot of these for the Aussie CAD, for example, just say no viable trades because there's nothing above 70% within those. So you can see that dirty pressure sell Aussie CAD is probably not the best setup, right? Buy, you can see there's a ton of them. There's 1 no viable trade right there, and 2 right there, and 3. But on this side, you've got 3 times that amount. Most of the day is no viable trades if you're taking a short with dirty pressure on the Aussie CAD. So some good information there. All right, let's continue. So what we did was I've been working. I had a guy that this is a user submission, and so basically what he did is he said, I've been noticing that there's this trade that appears for me, and I've been working on developing it. He says that I'm demo trading it, it's doing really well, and so he wanted us to take a look at it here at the mastermind. And so what we did was I just started backtesting it manually because I wanted to use this as an example and also show you guys that I'm not above backtesting myself, right? I still backtest manually just like this, just like I expect you guys to. So let me show you the data on that. So I just started doing this 2 days ago, and I've just been picking at it, and I haven't really been, going, hardcore. But you can see it actually happens really often. Right here, 1/5/2016 was the first one that occurred, and from that point for this year, the year 2016, it had, and I'm not done yet, but it has about 129 examples. Now, this is for every single time, right? So I'm not just picking a specific time. I actually have every single time that it happens from, midnight to 11:59, right? So 24-hour period, anytime it happens, and this is for the Euro USD, I've recorded it. So you see it happens pretty often, and it's actually one that's really consistent. So I wanted to discuss how you get to a place to determine that you've got a trade set up, right? And so the first thing is it starts off in a way that we obviously always recommend that you don't decide to do something, and that is based on perception, right? You get a perception of something. Something happens, you see the lines do a certain thing, and consistently it has a certain result, right? And so you have this perception. Now, you don't use that perception to trade on, you use that perception to test on, right? And so his perception was that when the thick orange line, so I'm going to break this down for you, the first parameter is the thick orange line. Hate when I have to do that. The first parameter is the thick orange line. And the thick orange line has to be at a -50 or 5 if you're using green chart 2. So it's halfway, right? Because it goes top to bottom is 0 to 10 in green chart 2 or 0 to -100 in green chart 1. So right here, it would be negative 50, for example, or 5 in green chart 2. And if it's pointed up, let's say it's up, right? It's not flat like the half top, it's just pointed up. Then you want the thin line, the thin orange, to be above it and pointing up. Now, this is where I became skeptical because the thin orange being above the thick orange can happen regardless of value because they're working on different values. They have the same scale, or they have the same value, but it's kind of on a different scale. So here we can see that the thin orange is actually above the thick orange, right? Just at a glance, right? As you're looking at it, the thin orange looks like it is. That's the end of the thin orange. That's the end of the thick orange. So thin orange looks like it's higher with a value of 14.51. But you could have the same exact value and be down here, and the thick orange be at 50. So I'm not sure how that plays into it, but I said, okay, if those are your parameters, I want to check them out. So we have thick orange pointed up in this case with the value of negative 50 or 5, and in green chart 2. And then the thin orange pointed up but just above in height above the thick orange, right? It doesn't matter if it's on the left of it or right of it, just that it's above, it's higher than the thick orange when you look at it, when you know, from just with your eyes, not necessarily the value. And majors, so that's the second variable. The third variable is majors are pointed up. And that's it, right? Those are the three. So, and then in reverse, it's negative 50, majors pointed, thick orange pointed down, thin orange pointed down but lower, and then majors pointed down, green, red, and majors pointed down. Okay, and then that's a cell. Okay. So how do you come to that conclusion, right? How do you determine that those are your parameters? Well, again, it's just perception, right? You've perceived that when this happens, it works out well. And so you say to yourself, well, that looks good. So sometimes what you start with, let's say, for example, this gentleman started with just the thick orange, right? And the thick orange was up, and then the thin orange, maybe he didn't have the thin orange, right? Thick orange was up with a value of negative 50 or 5 on green chart 2. And the majors were up. And maybe the majors were up oversold or in the channel or not overbought, right? And then you realize, okay, you tested a little bit, you realize, you know what, that's not really relevant. Anytime the majors are up and that thick orange is at 50, I'm getting the desired result. Or, you know, it's still a little choppy, I don't get a lot, I get some movement, but not a lot. So then you start looking for other things, right? Okay, what else can really help this? Could it be minors, if minors are also pointed up? Or could it be pressure? Well, in this case, for this gentleman, it was the thin orange. So he said, well, when the thin orange is also pointed up, and it is, and maybe he said, you know, thin orange is pointed up, right? And then he realized, okay, yeah, when the thin orange is pointed up, that's great, but it works out even better when the thin orange is pointed up and appears to be above or higher than the thick orange. So now we have majors just pointed up, right? Thick orange pointed up with negative 5 or 50, and thin orange pointed up, right? We don't care if majors are overbought, oversold, or in the channel. We're not looking at the value of the thin orange, and we're only looking at the value of the thick orange, and it has to be at negative 50. And we have all these things, and we start finding that consistency, then we backtest it. So right now, the proving ground, right? The proving ground is, and you guys learned this last week, right? January 2016, so January 1, 2016 through December 31st, of 2020. That is the proving ground right now. That means that when you backtest, you go all the way back to January 2016, and then the specific times that you trade on the specific currency pair, you test your specific setup, right? So what I've done is I've just taken all of the hours, which is going to take a really long time, but I'll finish it eventually, and I'll share the data with you. But then we backtest. Before we do that, though, we got to establish what we're looking for. And sometimes that even evolves. Maybe we're going back on the data, or we're backtesting the data, and we realize that, the pressure indicator seems to have a bearing on how much it goes in our favor, or if it even works out in our favor most often, or the like. And really, when we say in our favor in this instance, we just want it to go up, right? We're not saying how much up. We're just thinking it's going to go up. And then when we collect the information, then we want to see how far it went up before or after, a certain amount of drawdown. And then that's what gives us our stop loss and take profit, right? And we got to establish that at a win percentage. But I want to show you guys something. So we collect this information, and so I'm going to bring this information up, and you guys can go and validate this information, of course. Take a screenshot of the screen right now. You have the date, currency pair, direction. 1 is buy, 2 is sell. Okay, the time, UTC. So this is if you're in Utah or in Mountain Time Zone, this is 6 hours ahead of you. And if you're in Eastern Time Zone, this is 4 hours ahead of you. So 0 is midnight. And so if you're Eastern, right, that's 8 o'clock, right? This is 8 o'clock that this happened, which means you would execute at 9. If you are Eastern or Mountain Time Zone, that's 6 o'clock, 6 p.m., and you would enter the trade at 7 p.m. So this happened at the 6 p.m. candle. This happened at, or midnight. This is 1600 UTC candle, so on and so forth and so on. So that way you guys can know where to go and find those. So I just explained to you the setup, and I showed you guys where to find them, okay? And here's the data, right? And if you go back to that video that we showed last week on the session that we covered live last week on the golden ratio analysis, you can see how we got these results, right? And then I just made some additional just in case, the data falls out where I need it, but I just kind of, let myself know how far it went after I stopped counting, after I met my parameters based on the golden ratio analysis, which really helps. Not on every single one of them, just the ones that I thought were relevant. You see, so we've got a pile here, and then I wanted to check it because it was doing really well in 2016. So I wanted to check 2020 because 2020 was kind of crazy. And so I just kind of scrolled down, and then I started 2020 right here, and I got to about March of 2020. So those are the parameters for that. But let's just look at the data for 2016 first, okay? Because I want you guys to be able to see how you do this, all right? And there's obviously there's a lot of value in us, giving you what you need to basically have done it for you, right? Or having that ability to walk through this process with a one-on-one coach, so that you make sure that you've got everything correct. Because if you don't know how to backtest, or you're just learning how to backtest, what if you go through all these examples and then you get to the end and realize you didn't do it right? Or you get halfway through and realize, I actually haven't been, I watched that video again, I haven't been doing it correctly. Right? So that can be a little frustrating, where if you have somebody to walk you through that process, it makes it a lot simpler. Okay, so here's the data, and here's what we can do with it. Obviously, at its face value at first, all we're looking to do with it is extrapolate the best parameters for stop loss and take profit. So let me put these back in order. So basically all I've done is I've taken the time, the duration, the drawdown, post-trade movement, and post-trade movement duration, which is just this stuff right here. Did I get direction? Nope, I didn't. I guess I can hold off on that. Let's just get it. We're here. Let me just grab this real quick. Okay. Insert. Of course. Okay. Okay. There we go. Okay. So now we've got direction, we've got time, the time that it occurred, the duration, how long it took to draw down and come back to break even, how much it drew down in that time, and that's probably backwards. That's 25 and 3.6. Not sure why I did that. But let's go back to that first, so just to double check it. So we're going to be looking at that first example, which is 1/5/2016 at midnight UTC. So let's go here. So 1/5, and we're going to make that 0. Okay. So right there. If we go back to this one, we see this one didn't qualify, even though it has a red pylon, because that thin orange is not below the thick orange. So that did not count. That's why you don't have that one marked. Now, let's go to this one right here that does have all the parameters, right? We've got thick orange pointed up with a value of 50. We've got thin orange pointed up above thick orange. And we've got majors pointed up. So we have everything that this trade called for. So then we go 6 candles. 1, 2, 3, 4, 5, 6, right? So what is the highest point it went before it drew down? And that's right here, 6.7, right? Right there. So if I want to know, okay, how much did it draw down before going 6.7 pips, I can use this 5-minute chart, right? Let me erase that. I can say, okay, from right here, when did you go 6.7? Right there, 6.7. So if that's 6.7 from there to there, then what's the lowest point it went before going to 6.7? And that's here, 3.6. And look, it went 3.6 pips down to there, and then that's over 20 minutes. And then right here, it would have come back to break even. So in that 5 minutes right there, right? So 25 minutes back to break even, and then 5 minutes is post-trade movement duration. So from break even to peak profit was 5 minutes. So right here in our data sheet, it says 3.6 pips. No, dang it, that was right. What am I doing? 25 and 3.6. Okay, duration, 25 minutes of drawdown. And then it went 3.6 pips in that 25 minutes before coming back to break even. And then after coming back to break even and moving into profit, it went into profit 6.7 pips over the next 5 minutes. And then after that, it went 17 pips against. And that's why I put that right here, because that's only 5 and 3.6. So if I find that for that time, I can get more, profit or whatever, or I need more drawdown, then I can see that there was 17 additional pips that it went against that position. So if I needed that to validate whether or not I could use this, then I would have what I need, right there. Or I would know that I don't have to look at it twice, that it was just a loser and that's all there is to it. Okay, so then so we've done that now, numerous times, right? We have all this information. This is not complete. Obviously, we're almost at the end of 2016, which only leaves 4 more years to do. So let's look at what we have. Let's just say that this was complete, and let's look at it. So how would we look at this? Well, for one, because we're using multiple times, we could do it a number of ways. One is look at each hour and see how that hour performs, right? So midnight, how does midnight perform? 1600, how does 1600 perform? And get all the midnights, all the 1600s, get them all together, and then analyze them individually. That's one way of doing it. The other is just by session, right? By session time. And that would be going and saying, okay, from midnight Mountain Standard Time to 5 a.m., let's call that the red eye session. So that would be like 2 a.m. to 7 a.m. Eastern. That's the red eye session. So that's, it starts at midnight and it ends at 5:59. And that's Mountain Time. This is UTC time. So I'm just going to put right here MST and UTC. Okay, just so we know the difference. Put that there. Okay. So I could just take these blocks and see how that plays out. But first, let's figure out how we're going to analyze this first, right? So let me get rid of that one. Let's open up a new one, just so we have a clean sheet to work on. Okay. So let's take the time and sort all of these by the time so that they're all in order, right, by time. What is going on here? Huh. Okay, that's strange. All right, let's take this again. Copy. And let's paste it. $129. What in the world did I do? Okay, I know what happened. Right here. These are probably from the 2020. Okay, delete. Okay, problem solved. Crisis averted. Okay. All right, so right here, we're going to sort these by time, right? We want to look at them based on, or in order of the time of day that they occurred. Not the date, just the time of day. So we could take all of these 0 to, well, I guess 0 would be down here. So 0 to 5. So we took all of these that were 0 to 5. So let's go 0, 1, 2, and 3. There's no 4 o'clock yet, so 5 right there. Copy. And we'd just look at these separately, right? So we'd say, let's paste those, order. And let's say 0. To 5 UTC, okay? And then we'll go 6 to 11, right? So right here, we're going to go 6 to 11. And 12 to 17. And 18 to 23. 100 hours, right? Copy. Paste. All right. Then we can separate these and look at let's look at drawdown first. Okay. So right here, I'm just going to sort this. Actually, let me do this first. Come on, Hiram. I just want them to be in order so I can reorder them if I need to. Okay. So let's take drawdown first, okay? And let's look at drawdown. So out of all of these, the most drawdown we had was 26.3. Now there's about 38 of these, right? Or 37 of these. So let's look. There's about 37 of them. So here's what I'm going to do. I'm going to put right here, I'm just going to put total and 37. Now, okay. So there's 37 total. Now, if I wanted to get, let's say, 20%, let's just say 20%, no more than 20% loss, then I would be looking at of 37, that's going to be 7, so about, let's just call it 8 losers. I can't have more than 8 losers, and that would put me at 80%, right? So if this was, if I'm starting from here, I want to see, okay, how far does 8 get me up this ladder right here? Right here, 7.5. So if I had an 8 pip stop loss, let's say for example, if I had an 8 pip stop loss, then I could do as low as a 3 pip take profit and still be profitable, right? Because with an 80%, you could have up to a 3-to-1 risk to reward. That means that your stop loss can be 3 times greater than your take profit, and you can still be profitable. Scott says, with green chart going away, the new green charts have only 2 years of data. How would you backtest beyond that? You can actually right now get back to 2017. It's something I'm working with the developers on, with Andrew specifically, and it's one of their top priorities, is to get that additional year in there. Actually, let's see. I think you can get back to 2018, sorry. But they're working on getting those additional 2 years in there. So right now, I can go back, I think, to the beginning of 2018. Let's just try that real quick. Yeah, so this is 128, but I can get back to 2018. Let's see. They're always making adjustments to this stuff, so let's see if we can go back to 2017. Let's just see if we can go back to 2016. January 1st. Nope, and it's going to pick up 1/1/2018. Yeah. So right now it goes back to 2018, January 1st, 2018. But they're working on it so that we can get back to 2016. In the meantime, just go 2018 to 2020 or 2018 to current. And then once they make that update, then you'll be able to go back to 2016. If you have access to Green Chart 1, just do it in Green Chart 1. Okay. So right now I can see that if I only have 8 trades, if I looked at doing an 8 pip stop loss, right, then those would be losers. Let's just mark these really quickly. Let's just put a 2 here for loss. So that's everything that is drawdown 8 pips, right? And then let's go here and let's sort this post-trade movement. And we can see that if we needed at least 3 pips, we could probably even go less than 3 pips, but let's just say at least 3 pips, then out of all of these, we would only have 1, which is already counted as a loser, that did not go 3 pips. Everything else went at least 3 pips before anything greater than 8 pip drawdown, with the exception of the ones that are marked as 2, right? So let's do this. Let's go. Let's do 1. Come on. go like this. So if these were our parameters, then we know that we can win 31 of 37. So won, right? 31 and then lost equals that minus that, and then percentage equals that divided by that times 100. 83.78%, so about 84%, right? So 84% we can win at a 3-to-1. So what does that look like? Well, let's look. Let's say this equals that 31 trades won times 3 pips, and then equals 6 trades lost times 8 pips. And then this will equal that minus that, and that is 45 pips won. Okay, so out of 93 pips that we won, and then subtracting our loss, we still ended up with 45 pips, which is about half of the total pips that we won after loss. So we still walked away with quite a bit. So 45 pips out of that sequence. If we had, so that is with a 3-pip take profit, right? Well, what if we had a 4-pip take profit? Well, then that means that we would have an additional, let's see, so let's make this a loser, 2, 2, then everything else is a winner up to 5 pips. So we could actually just do, well, we'll look at 5 pips. Yeah, we could even do a 5 pip, because that's 5.5, so that does account for spread as well. Okay, so let's do this. Go draw down again. Because again, when we do the golden ratio analysis, we don't just get to have one possible yes. We can have multiple yeses. We can have multiple trades that give us profit, right? So right now, we just looked at a 3-to-1. Well, pretty close to 3-to-1, right? It's a 3-pip take profit, 8-pip stop loss. So a 3-to-1 would be a 9-pip stop loss and a 3-pip take profit, right? But we're looking at just a 3-pip and an 8-pip. Now we're looking at a 4-pip take profit and an 8-pip stop loss, which is a 2-to-1, right? And so with a 2-to-1, we've got 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29. 29 won, right? So right here, this would be 29. And that would be 8. So that would be 78%, pretty close to 80, right? Actually, let me do this. Control-C. So let's go. I want to make this up again. Copy, because I want you guys to see the difference. Paste. Okay, so this was 29. And this right here would be 4. And this right here would stay 8, right? Because now we'd get an extra pip. Now this, so if you look at this right here, right, we have 45 net pips, okay? So that's 45 net pips after win, loss, that's what we're left with, okay? Now we have a lower win percentage right here, right, 78. So almost still about 80, but 78%. But here we have 116 pips won because we went from 93 with 3 pips per trade to 116 with 4 pips per trade, okay? And then we went here and we stayed at 8 pips per loss per trade for 8 trades. So that increased to 64, right? But that increased to 116. So 52 net pips is what we're left with, right? 52 is more than 45. So we would actually use a 2-to-1 risk to reward ratio. That would be more profitable. Even though the win percentage is less, who cares? We're making more profit at 52 net pips than 45, right? So we know that we could even go as high as 5 pips, because we saw that the one trade that said 5 pips was already a loser. It had already gone 8 pips prior to that 5 pips. Not this one, right? But, let's see. So that one right there, that one was already a loser because it went 9 pips before it went 5 pips. And we're looking for 8 pips, less than 8 pips, a drawdown. So that was already a loser. This one's 5.5 pips, and that one did not draw down 8 pips. So that one was a winner, and that does cover spread, and everything beyond that was above 5.5 pips. So we could even say right here, instead of 4 pips, we could say 5 pips, and we don't have to add or subtract any winners or losers because we don't have at 5 pips, all the winners and losers are accounted for. 5 pip take profit, 8 pip stop loss. They're all accounted for already. So if we did that, if we took 5 pips with an 8 pip stop loss, and this is of course not complete data, right? But if we did trade it from 0 to 5, okay, then we could take, if this was our complete data, we still have 4 more years to do, but if this was our complete data, look, we have 3 trade possibilities that are all profitable, all of them. Did someone do this backtesting you have here in the spreadsheet, or is this your Proving Ground program recording the data, or is that how the Proving Ground operates? Actually, the data that is collected right here, I did by hand, just like I would expect for you guys to do. So I just went back, and you can see my marks where I was measuring. So that's 1.5 at 0, 0. That was the first example I found. And then the next one is right here. That's the next one I found. And that's 1600, 1.5, 1600. There's the next one I found, so on and so forth. So I did the back testing on this. That one right there, if it's not marked up, it's because it's probably not 1. Yeah, see, so this one's not 1 because thick orange is at 50. Thin orange is below when it's pointed up, so that one did not count. That's why I didn't test that one. But so no, I did this by hand, manually. So it does take a little bit of time, especially because I'm testing all hours and not just specific hours. But then I get to break it down in really fun and interesting ways. So here's what's interesting. So check this out. So we have 78% on this one as well, right? Because we didn't have to adjust any stop win or losses. But now we have 81 net pips. 81. So we would have walked away with 81 net pips out of that, and that's out of 37 trades. So to give you a breakdown of that, 81 divided by 37 is about 2.18 net pips per trade. So we're going for 5, so we're taking almost half home with us, right, in terms of net pips. So 78% with a 8 pip stop loss, 5 pip take profit is really profitable, right? Much more than 84% with a almost 3 to 1. Now, here's why we break it down based on these times, because the market moves differently at different times, right? So right here, this is 6 to 11 UTC, right? And let's look at if there's any big difference between what we saw with 0 to 5 and 6 and 11. So first thing, we didn't add that. So let's copy and then If I do this, insert, copied cell, shift cell down, it's going to mess some stuff up. Nope, we're good. Okay. And then let's do the same thing right here. Insert. Copy, paste. Okay. All right. Let's look at 6 to 11 UTC. And let's do the same thing. So first we're going to take drawdown, right? We're going to look at drawdown. And there's about 32 trades there. That would have been easier. Okay. So let's take drawdown. And let's look at our drawdown. So we know we got 32 right here. So we're going to do the same thing we did here. Okay. So we've got 32. And so I like using a starting point. So about 6.4, so 6.5 trades would equal 20%. So we could have up to, let's just say, 7 losers. And let's go, I'm going to put this here, 32. Get rid of that. Okay. So let's go from right here, and let's go up to 7 trades. 3, 4, 5, 6, 7. See, much bigger numbers, right? There's 19.6. So let's just say at 20, we'll say a 20 pip stop loss. So these are all greater than 20. So I'll mark them with a 2. All right, let's go up here, and let's see. If we have 80, so then we can go as low as, let's just say, 7, right? Because 7 times 3 is 21. So let's just say 7 pip take profit, right? And that's going to be about right there. So let's look at that for a moment. And look at that. It goes from 7.2 all the way to 11.9. Okay, so let's look at this first. Let's say all of these are losers. And everything 7.2 and greater, or 7.3 and greater, would be profitable, right? Just want to show you guys what this looks like. And believe me, there's an easier way to do this, but I kind of want to walk you guys through meticulously. All right. So we have, let's see. Just going to take this really quickly, copy. Out of those, we've got 22 winners, right? So 32, and then we have 22 winners, which is about 70%. And that's if we used that 3 to 1, right? So we would not make profit there. This would be 7, and this would be, what did we say? 20. Look at that. We would not make profit. So we know we can't use a 3 to 1 with 70%. It just doesn't work, right? Now we know that it jumps from 7.6 to 11.9. So let's say 11 pips take profit. 11 pips take profit means we have one more loser, so this becomes 21, right? And this becomes 11, and that remains at 220 because that's still going to be 20, right? And we're at about 11 pips. Now we know it's 11.9, so we could even go to 11.5. Let's go here, 11.5. Whoops. 0.5. And that gives us 21.5 net pips, right? So right here we had, if we did 11, it gave us 11 net. 11 net. But just going 11.5 gave us quite a bit more, right? Hold on, is that right? L38 21 times 11.5. Yep, let me double check that. Yep, 241.5. And then we've got 220 there, and just that extra 0.5 knocked us up to 21.5 net pips. So 11.5, right? So check this out, right? Because we had 11. So we started off with something that was not profitable, and we looked at our data again, and we said, okay, what else can we do that would give us more profit, right? And so we found our little sweet spot, and that was right about there at the 7 mark, right? Because we know that we needed at least 3 times the stop loss that we had determined, which was 20, and so that gave us 7 is just above a 3-to-1, right? Because it's 7 times 3 is 21, and we were looking for a 20 pip stop loss. But that was not profitable because it only won 69% of the time. So we said, okay, what's after 7.6? We have this big jump up to 11.9. So we said, okay, what about 11? So when we look at 11, that gave us right here, right, 11 pips for 21 winners, and then 20 pips loss for 11 losers. And that gave us 11 pips profit out of that sequence. And then we said, okay, well, what about just half a pip extra, right? So right here, 11.5, right? And, 11.5, and then the same amount of losers, right? Why? Because this is 11.9, and we need to cover spread, so we give ourselves 3 micro pips of spread, and that's 11.8. So we'll just call it 11.5, and 11.5 almost doubles our profit with a 66% win rate. So we're at 21.5 pips of profit for that sequence, right, including the losers. Okay, so and you can see, look at the big difference. For one, this is taking more pips in profit, right? These are taking more pips in profit. Obviously, there's bigger stop losses. They have lower win percentages, and these have higher win percentages, but small movement, right? 3 and 8, 5 and 8, 5 pip take profit, 8 pip stop loss, right? So it's almost like half the size of trade as these, but it's more profitable net pip wise, and it's a higher win percentage, which means we can use a higher risk percentage, which means overall it would be more profitable. This trade would make more dollars in 5 pips than this would make in 11.5 pips. So you could get 11.5 pips here, and let's just say, I want to break this down for you guys so you guys understand this. Okay, so right here, this one is 80%, almost 80%, right? And it has an 8 pip stop loss and a 5 pip take profit. Okay, so that's like a 1.5 to 1, right? It's a really good. So let's say we're going to risk 4% right here. We're going to risk 4% on these trades, okay? and we've got, let's just say, so risk 4%, and then I'll wrap up with this, guys. And let's just say we got a $10,000 account. Okay. Because we can risk 4% because we have a high win percentage and a really small risk to reward, right? We're not even at a 2-to-1 risk to reward on this one. But here we're at 66%. So because we're at 66% right here, then we have to use a smaller win percent. Let's just say 1%, right? And we have the same $10,000 account. Okay. Now, on this trade, if we're going 1% in 20 pips, 1% of 10,000 is 200, right? 1% of 10,000 is 200. So 200 in 20 pips would be a 1.0 lot. Because 1.0 lot is $10 per pip. $10 per pip 20 times is 200. Okay? So 1.0 lot, and we get 11 pips, which is, what, 110? $110. That's what we would win if we won. Hold on. 1.0, 11.5. So it'd be 115, right? 115. And right here, 4% of 10,000, right, is $400, and that would be an 8 pips. So 400 divided by 8 is $50 a pip. Okay, so that is a 5.0 lot size, which is $50 per pip. 5.0 lot. And we would only be making 5 pips right here, not 11, 5. So $50 a pip 5 times, right? 5, 10, 15, 20, 25. So this one would make $250 per trade. This 5 pips makes 250 bucks. This 11 pips makes half of that, less than half of that, $115. Do you see? We don't just get to make up these risk numbers, right? We do them based on the probability of back-to-back losers. We don't get to make up what our stop loss and take profit are because they may not work. Like right here, we try to just say, well, what if we did a 7-pip take profit and a 20-pip stop loss? That sounds great, and you might win a lot of them, right? You might win a good amount of them, but if you don't win enough of them to make profit, then it doesn't matter. You would only win 66%, so you would not make enough profit. Well, smaller trades, larger lots, not always. It just depends, because if this one was 66%, then we would be risking less on this trade, and if this one was 78%, then we'd be risking more on this trade. So it's just about your win percentage. That's what determines your lot size. And so if both of these trades were the same, the exact same, if this was 78% with the same risk to reward, let's just say instead of 5, it's 20 pip take profit, and then instead of 8, it's 32. So it's a 32 stop loss and a 20 take profit. Then we would risk, so this is a bigger trade, right? So it's not a smaller trade. It's a bigger trade, but it has the same win percentage. And so the lot size for this one is going to be relative. It's going to make the same amount. It's going to make the exact same amount. The lot size may be smaller, right? The lot size might be smaller, but it's going to earn the exact same amount as this one because it's going to use the risk percentage of 4. So if we had a 4%, so a 10,000 is $400 in 32 pips. So 400 divided by 32 is $12.50, right? So yes, this would only use a 1.25 lot size, right? But it would be a 1.25 lot size for 20 pips. right? So 1250 times 20, so equals 1250 times 20 would be 250 bucks. The exact same as that one. So really, the lot size is just relative. It's just relative to your stop loss, and your risk percentage tells you how much you're going to make per trade. You can have this risk percentage on 1 pip, or on 100 pips. It doesn't matter because they're all going to, and if the risk to reward is the same, they're all going to equal $250 profit. So, I mean, technically, yes, to answer your question, the lot size is going to be smaller with a larger trade, but it's relative, right? You're still going to make the exact same amount. Win percentage determines the lot size to risk. Win percentage and risk to reward determine the risk percentage. Yes. Yes. So you would have win percentage, risk to reward, and then that would give you your risk percentage. And the reason for that is because of the probability of back-to-back losers. With a 66% win percentage, you could have 5, maybe even 6 back-to-back losers. If you're risking 4%, right, in 6 trades, that's almost 24 pips or 24% that you would lose, not if, but when you hit those 6 back-to-back losers. That would be almost 24% that you would lose of your account. And you want to stay not losing more than 5% per trade, or not losing more than 10 to 15% total after a sequence of losers. You want to stay within that realm because psychological reasons, it's easier to dig back out, so on and so forth. So there is some psychology that goes into keeping track of your risk percentage. And for more specifics on that, you can go into the mastermind. You can look at some of the videos that we've done for those of you guys that are mastermind members. And you look at the videos that we've done on risk percentage, risk to reward, things like that, and we have charts in there that break down what risk percentage you should be using for what win percentage and what risk to reward, so on and so forth. So all of it is there for you. Also, you could if you want to be really conservative, you could use the risk calculator that's in the mastermind as well, and you just type in your parameters and it'll tell you what your stop loss is. Here, let me show you. That'll be an easier thing to show you really quickly because we're already over on time. But let's go to the calculator. So let's say our balance was 10,000, like we're looking at today, and our win rate was 78%. Is that what it was? So this is going to be really conservative. You can see right there, it's only recommending a 0.5% risk. If I go to 80, it'll kick it up to 1, but that's like the low end, right? That's the low end of the spectrum. If I go to resources, and I go to risk percentage cheat sheet, and it gives you this with a range: 70 to 79, 0 to 3%, 80 to 83, 1 to 3, 84 to 86, 2 to 4, 87 to 89, 3 to 5, 90, 4 to 5. And the only way you really play around with those is with your risk to reward. If your risk to reward is really good, then even at 75, 73%, you could still use 2, 3%. Because your risk to reward is really good, especially if you have a reverse risk to reward. Your reward is greater than your risk, so you have like a 10 pip stop loss and a 20 pip take profit. So you can see how we can dissect this information. And look, this is just the first layer, guys. This is once you do the golden ratio analysis, right? And look, I want you to go to any video you want on YouTube, any other video except this one. And the golden ratio one that we taught last week, or any of the back testing videos that we've taught on the Proving Ground YouTube channel. Okay, go to any other, just type in back testing Forex and see what they say and compare it to what we just said. And this is why we win. This is why we have successful day traders. This is why we have hundreds of traders day trading our corporate funds, max funded at $100,000, and they're keeping 80% of the profit, and they're trading seven-figure. They're earning 7 figures, right? This is why. This is the biggest difference in what we do and what everyone else does. Does it take a lot of time? Yeah, okay. To do these, just these right here, I'd say it took me about 2 hours to get 130 examples. And if that represents a year and I have 4 more years to go, then that's about 8 more hours that I have of doing this, right? Let's call it 10 hours. 10 hours can make the difference between losing at day trading and dominating and being a professional day trader and slaying it in the market. The night and day difference. It's not just like this little blip of difference. It's having the right tools and knowing how to use them. Nobody's talking about this because they're lazy and they're just trying to sell you garbage. And that's just the way it is. I'm not going to sugarcoat it. It's just the way it is. I tear those guys apart all the time. Show me one person that's talking about day trading correctly. I'd love to see it. I do, and I'm not being facetious. I would really love to see that I'm not the only one that's talking about it correctly. All right, we got to wrap up. I realize we're over. I do appreciate you guys sticking with me. I'm going to wrap up with this. This is how you start trading our funds. You try it out. $10. You get access to the indicators. You get access to the training videos, continuing education, trading webinars, trader chat for mobile and desktop, the real alerts, real-time alerts, and 2 sessions one-on-one. You go to daytradesmart.com/free. It's no longer free. It was. We changed it. That $10 that you pay for the Trader Lite for 30-day enrollment, within 2 weeks you'll know if it's a good program for you, and then we can talk about the next programs, which range anywhere from $8,000 to $23,000. Now, that's just a big number for you right now. It doesn't matter to you right now. But when you realize the power of what we're offering, and you realize that you can literally become a 7-figure day trader, then it's all relative, right? Some of you guys paid a lot more for college for that. And tell me, how's that degree working out for you? Are you even working in the field that your degree is relevant to? Are you making at least 6 figures or more? Was it worth it, all those years? Because we can get you cleared and trading with a funded account within 6 to 9 weeks. So that's like going to college and cramming it in 6 to 9 weeks and getting job placement and be proficient enough to make a profit long term. All right, so don't delay. Jump on this, daytradesmart.com/free. Let's get you guys signed up for the Trader Lite. And until next week, happy trading. Have a good one.